Good morning, everyone. So we are in part 4 of Introduction to Financial Management. We continue from where we left off. So we know that in a business, particularly in a company, you have agency conflict or agency problem. So how do you manage this agency conflict or agency problem? You cannot eliminate the problem, but you can minimize the agency cost or the agency conflict. So how do we minimize this? Okay, we minimize by managing the managers. There are three strategies given here. One is to manage the managerial compensation. Here it means how much and how you compensate, you pay the managers. Okay, so you give them incentives that can be used to align management and stockholder interest. Meaning, the goal of financial management is to maximize current value of the owners, the shareholders' wealth, right? So, if whatever decisions that the managers make increases the shareholders' wealth, then you can give incentives to the managers. Okay, so if this criteria is met. Okay, so this must be aligned. Okay, aligned with the financial management goal that we have seen is to maximize the current value of the owner's equity. So as long as the owner's equity is increased, then you can increase the incentives to the managers. Okay, so the incentives need to be structured carefully to make sure that they achieve their goal. What is the goal? The goal is to maximize the shareholders' equity, the owner's equity. Okay, but then there is a likely problem here. One is you can here you go. Okay, the managerial compensation must be aligned to the shareholders' wealth, but you must avoid significant insider ownership. If you align too much, for example, and you allow the management to have greater control, meaning managerial ownership of the company, then there will be a lot of insider ownership. Managers also have ownership in the company, and therefore this leads to more problems, more conflict of interest. The managers may try and benefit themselves at the expense of other shareholders. Therefore, this may be a worsening of the problem. So the compensation needs to be correct. You can give share ownership to the managers, but ensure that the insider ownership is not too significant. Okay, so this is another issue here, how you can manage the managers. Then the other way to manage the managers would be to have greater corporate control. So when the corporate control is better, then the managers will be kept in check. Meaning they will not abuse their position. Because there is a threat of takeover. Meaning if the managers don't perform well, then there will be shareholder activism. Meaning the current owners of the company can undertake a change in management. They can vote out the managers and bring in new management. So this is the threat of takeover. Okay, and this will make sure that the managers are aligned to fulfilling the shareholders' interest. Okay, then there will be other stakeholders, for example, institutional investors, and then you can also have the government, the regulators and all that. They can also make sure that the managers are doing what they are supposed to do. That is to maximize shareholder wealth. But there is also a but here, meaning caveat. So you can provide monitoring. The stakeholders can provide monitoring, but they can also influence the company or the business negatively. If they are given too much space or authority. Okay, so this must also be balanced. Okay, there must be check and balances so that no one particular person abuses the position. Always check and balance is a the best tool to make sure that everything is ordered. If somebody does something, someone else checks that the person has done the right thing. Otherwise, they report it. Okay, and then there will be action taken. So that there will always be checks and balances in any system. Therefore, in managing the managers too, there must be enough check and balances to make sure that the managers are doing the right thing for the shareholders' interest. Alright, with that we move on to the next. That was the fourth key concept. Now we come to the fifth and the final key concept in this chapter, which is the relationship between the company, the firms, okay, as you can see here, firms, and the financial markets. Remember, the final key concept is the financial market. Alright, so how do the company here, you have the firm here and you have the financial markets here, how do these two relate to one another? This is what we're going to see. Okay, so you can, this diagram is quite useful because it has been numbered. So you have A, then followed by B, then you have C, D and E. So we can, and then F here. So we can follow this order. So here the firm will issue securities. The arrow shows here, okay, issue securities. Actually the firm issues security, but the arrow here refers to the cash flow. The cash flows from the financial market to the firm. The firm issues security, but the financial market, here the financial markets will be made up of investors and creditors, of course. Both investors and creditors will be here. What they will do is they will purchase the security issued by the company and they will pay them money. This money will be in terms of funds. We call that funds. Money is usually used for short-term. Short-term purposes, we call them money. But funds will be a term that does not state whether it's short-term or long-term. Then we have this term capital. Capital means long-term funds. So money is short-term funds, capital is long-term funds. But funds will mean any term. Can be long-term or short-term. So that's the difference between money, funds and capital. Funds is the general term, and money means short-term funds, capital means long-term funds. So from the financial markets, you have funds flowing this way. Okay, there can be money if it's short-term, or it can be capital if it is long-term. And the firm issues security. Security will be in terms of debt securities, can be bonds, can also be shares, equity securities, or shares. Okay, so the financial markets give them funds and the firms give them equities, equities or securities. We call them securities or equity. Right, then the firm receives this cash or these funds and they use the funds to purchase assets, both fixed assets and current assets, both short-term investments, current assets, and long-term investments, fixed assets. And this use of assets will generate cash flow. So this term cash flow is very crucial in finance. Okay, and this is used widely in finance, not profit. And we'll see what is the advantage of cash flow compared to profit a bit later on. Right, so cash flows will be generated from the use of assets. Okay, and this cash flows will be used to do a few things. First, to make the payment to government and other stakeholders, and this includes government in terms of taxes, but also to pay other stakeholders like employees, the workers, then the suppliers, okay, will be paid here. Then some amount of cash will be reinvested in the business. Not all of the cash flow will be paid out. Some will be reinvested. So this is reinvestment will be used to purchase more current assets and more fixed assets. But some, after reinvestment, will be used to make debt payments. Okay, for example, to pay interest or to repay your debt, whether it's short-term debt or long-term debt, and also to pay dividends to your investors, your shareholders. So this is paid back into the financial markets because the financial markets are made up of investors. Yeah, so the investors are given compensation here. So this diagram as a whole, tells you how the firm relates to the financial markets. Is that okay? All right, let's move on. Okay, the financial markets can be divided into two types of financial markets. Yeah, one is called primary. The second one, second type is called secondary. Yeah, primary and secondary financial markets. What is the difference between the two? Yeah, okay, and we'll look at that in the next slide. Yeah, primary and secondary. But what's the difference between dealer and auction markets? Yeah, dealer and auction markets are secondary markets. Secondary markets can be divided into two types. Yeah, one is called dealer, the other is called auction. Yeah, so we can divide this financial markets into various categories. Yeah, first is primary or secondary, and if it is secondary, we can divide this into either dealer or auction markets. Yeah. Okay, let's look at what is primary. Yeah, primary is when the issue of security, debt security or equity security, provides funds to the issuer, the person who issues the funds, issues the security. Yeah. So when the funds reaches the issuer, then it's called primary market. Yeah. The difference with secondary is that it involves sale or purchase of securities, not involving the issuer. Yeah. So this provides liquidity or saleability. Okay, liquidity or saleability with no price compromise. Yeah, that's called liquidity. Yeah. So secondary markets provide liquidity and does not involve the issuer, the company. Yeah, the company gets nothing from the secondary market. Yeah. The company gets something, some benefit, but it does not derive the funds directly from the secondary market. Okay, the company gets the funds, or the business gets the funds from primary market transaction, not secondary market. Yeah, so that's the difference between primary and secondary. So in a primary market, the issuer, the company that issues the security will get the funds. In the secondary market, the company that issues the security will not be involved. Yeah. The secondary market only involves buyer and seller. Yeah, so it only involves secondary or third parties, second and third parties, not the first party that issues the shares. Okay, for example, it is like the car manufacturer. Yeah, it manufactures the cars and sells the car first time to the buyer. Yeah, so that is called the primary market. The auto manufacturer selling the car to the buyer. That's the primary market. But once you have bought the car and then you're not very happy with the car, you sell the car to another buyer. Yeah, and this happens in the secondary market and does not involve the car manufacturer, right? So that's the secondary market transaction. Okay, so that's how you should see this. Yeah. All right, dealer. Secondary market can be divided into dealer. This is our over-the-counter markets. If you like, these are informal markets. Yeah. And auction markets are called exchange traded or more formal markets. Yeah? There is one place, auction markets like the New York Stock Exchange or the Bursa Malaysia shares. These are called auction markets where the shares are auctioned, meaning there'll be a buyer and seller, many buyers and sellers, and these are matched by the exchange, a formal exchange. But dealer market will be you have to go through a dealer in a more informal setting. Yeah. So the Nasdaq market is actually a dealer market. Yeah. We call this over the counter because when you go and sell, you go and sell this to a counter, conventionally. Yeah. So we call this over the counter. Yeah. So that's the difference. Yeah. So listed is actually auction market. Yeah. So listed and over the counter. Over the counter are also known as dealer markets. Okay, so with that we finish this topic, and this is a review question of what we have covered in the first chapter, the 5 key concepts: financial management and what are the decisions. So we know 3 financial management decisions. One is capital budgeting, the other is capital structure, the third is working capital. And what are 3 major forms of business? We have seen sole proprietorship, partnership, and companies. What is the goal of financial management? Generally, it is to maximize shareholders' wealth, or owners' equity. Agency problem is when you have the separation of ownership and control.